Hey everybody, are you paying too much to trade options? Well, if you're not on public.com, the answer is yes. Public is the only platform where you earn a rebate on every option contract traded, and that's in addition to no commissions or per contract fees. There's no one else out there paying trading rebates, so you won't find a better deal. Bottom line is, if you're paying more than $0 to place an options trade, then you're paying too much. Switch to Public and start getting rebates on every single contract traded, only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description.
So I see you got the green shirt memo, Jeff.
I did. It's ironic and maybe poetic that we both chose to wear green shirts today.
And we look good in them. We make green look good. Hey friends, welcome to Investing Unscripted. I'm Jason Hall in a green shirt. That is Jeff Santoro, also in a green shirt. He is my good friend. He is the voice of the people, and we are back together recording. It's been a couple weeks, Jeff. How are you?
I'm good. It has been a couple weeks. I was away last week enjoying some vacation time with the fam. So last week you guys heard a guest pod by our good friends Ryan and Brett over at the Chit Chat Stocks podcast. But here we are, back together, back on schedule. You're not allowed to take any vacations. We're done with that, and we're just gonna go from here.
Yeah, we'll talk about July later. Have that conversation later. So we're gonna do our usual thing. We're gonna save our housekeeping for later in the show. We have an interesting show lined up for today. A topic that we're still kind of working on the name, but you can set it up.
The name of our podcast is Investing Unscripted, and I thought it would be good for us to have a completely unscripted conversation that's related to the market right now and some of the headlines we're seeing, and also the contrast between that and what I got to do last week, which was read a book about Charlie Munger. And I could not help but notice the juxtaposition of reading about an investor who has very clear and strongly held beliefs about the right way to invest and think about the market, and then had, rest in peace, and then contrast that with all of the craziness going on this week in the market, or last week in the market, specifically around Nvidia and all the news around that. And then we had some anecdotal evidence on our YouTube channel related to that, which we'll get into. So this is going to be a conversation that has very little structure to it. It's just going to be as if Jason and I were hanging out talking about the market. And it will be, I think, vaguely like one of the episodes we did a while ago around, the hardest part of investing and separating out signal from noise. And so there's going to be some recurring themes, but I think this is something worth returning to every once in a while and updating our thinking and talking through it. So I'm excited to pick your brain on this and talk through some craziness in the market and how we can think about it.
Yeah, me too. It's interesting. You and I had very divergent experiences while you were on vacation. As you were saying, you got to really kind of focus on thinking longer term and really getting deeper into your thinking about your investment process. And part of that is trying to learn from one of the greats, while I was unintentionally capitalizing on the absolute mania. And I wrote about it in last week's newsletter, the newsletter that went out. I think our first one in June that went out, just the bizarreness around the non-event that's a stock split that Nvidia was doing, and how berserk it seems like a certain cohort of individual investors are about it right now.
Yeah. And so let's start there. Let's start with the Nvidia video experience. So last week, while I was on vacation, or maybe even right before I left, you had posted, I think a day apart, maybe 2 days apart, 2 separate Nvidia videos. One, if I remember correctly, was mostly about just the company, and
they were about a week apart, actually.
Okay, they were a week apart.
Yeah, they were about a week apart.
And one was about the stock split. And I never watch your videos because I have so little value for what you think. But that one about the stock split was the one about the stock split was very good and a very clear, good explanation of why it kind of doesn't matter and why people pay attention to it. But the bottom line is these 2 videos combined got thousands of views, got us a lot of subscribers. And I think some people, because they'll just respond to anything with Nvidia and just buy it blindly and they don't really understand. But I also think it just speaks to when the signal that you get, and maybe it's noise, when people are really interested in one thing in the investing world. And, I know we were talking the other day, how many people have come up to us in our individual lives and just mentioned NVIDIA, like people who are not, investing nerds like us. And that's always, I think you said to me, it's always a signal when non-investors start talking about companies that maybe they've never heard of or don't really understand. But I think that was a pretty clear signal that there's interest out there, and it's because it's in the news. Like it's a headline, people are talking about it, and our YouTube channel was a nice little reminder of how that works.
Well, it's funny because if you read our newsletter, you've already seen this and you're tired of hearing what probably comes across a little bit as a humble brag about these videos, but it was coincidental, right? We've talked about NVIDIA a lot this year. We've talked about artificial intelligence a lot over the past year, the semiconductor industry, and all of those things are related. And it does seem like when companies do stock splits, there's a tremendous amount of interest from retail investors, regular individual investors. That's bizarre because it's literally cutting a pizza into more slices, right? So the whole thing that was interesting to me about what was going on with NVIDIA is it starts with something that's real. Everything that NVIDIA has done over the past really decade that's culminated with this explosion of profits as companies spend billions and billions of dollars to build out their ability to develop generative AI and eventually artificial general intelligence tools. I mean, it led to this moment. Now it's a company that's worth somewhere around $3 trillion and has been a massive, massive winner for investors over just about any time frame. And it's remarkable what they've done. And so the first video, the premise of it, now this is important to kind of understanding, getting back to the material aspects of what's going on with the business and then thinking through like the zeitgeist, is what I wanted to do was take the idea of the stock split that had so much investor interest and try to lead people, particularly newer investors that are trying to find their footing, like down the path of the thing that actually drives returns over the long term, which is earnings growth. And the headline was something along the lines of NVIDIA stock split. Here's the most important thing investors need to know. And what I tried to do was just start picking apart the growth potential for AI. Like, how could it really play out? And it's interesting, we had Nick and Casey on from Chip Stock Investor a few weeks back. And like I said, we've talked a ton about the semiconductor industry over the past year or so because of AI. But it is, as I went into this, I don't want to say bearish because I own NVIDIA. I do have a certain amount of conviction, but certainly with trepidation about the realities of how things could get ugly fast. And what I realized is when you start looking at the estimates, and you always have to take these estimates with a grain of salt, but the amount of money that could be spent over the next 5+ years to deploy the infrastructure to build AI is massive. I mean, it's absolutely massive. As much as NVIDIA has been a huge winner and super profitable, they could lose a lot of market share and double their profits over the next couple of years. It's mind-boggling to think about. It's really hard to wrap your brain around that. So that's real within the context of, well, Microsoft and Meta Platforms and these companies that are building it, they've got to get something on the other end or they're going to stop spending the money. Microsoft has to get Copilot 360 or whatever they're calling it into their enterprise software in a way that their customers are going to pay 80% gross margins because they get more efficiency, right? They get all the stuff that they're looking for from enterprise software. And if they do that, guess what? Microsoft's going to keep spending a lot of money on AI, right? So that was the whole focus of that one. And then the second video, which did like twice the numbers, I got a little clickbaity with the headline, but the idea was the same. The headline was something along the lines of NVIDIA stock split trade. I actually put the word trade in the headline, how to make the best profits on NVIDIA. And this is one that fortunately I've owned it since well before AI was expected to be like a core driver, but there were things like autonomous vehicles and EVs So like the prelude was there and the whole CUDA platform that they've built for developers, like all of that stuff has been there. But the whole premise was you have to be thinking long term and thinking about best in class businesses that are building something, a product or a service that their customers will pay a premium for, and the market for it is continuing to expand. And that video did even like, I think the two videos combined did something, I've done something like 90% of our views over the past month, which is extraordinary. And the channel's been around for 2 years almost, Jeff, and we added roughly 25% of our followers in the past 10 days.
And that's what I wanted to focus on. It's not, like you said before, it's not like a humble brag about the videos. It's more about that's never happened to us before where, I mean, there's been some videos that have done well, but those did particularly well. And it was like the perfect combination of what people are talking about, what's in the news. And it was earnings were right before the stock split. So it was a lot of Nvidia out there, and it'll probably slow down over the next couple of weeks as other things become top of mind for investors. It reminded me of, we had Peter Atwater on several months ago now to talk about
The
his book,
author of The Confidence Map.
The Confidence Map. Yeah.
Yep.
And he's an entertaining Twitter follow because the whole premise of his book is about how investors respond to what's in the news and that kind of a thing. And he's very good about retweeting headlines and saying something along the lines of like, there's a sentiment indicator in here, you know? And
Right.
that's what I see him do that a lot. So that was like what kept coming back in my mind as we were chatting about the results on those videos. I think I even said that to you a few times. There's a sentiment indicator in here. And
Oh yeah. Well, Jeff, I'll tell you, it's every other time in my investing career, I've seen this sort of mass amount of interest and frankly, uneducated interest because the comments, I'm going to make a follow-up video, 3 biggest misconceptions following Nvidia's stock split, because the idea that the stock is cheaper, it's like, well, yeah, a 12-ounce can of Coke is cheaper than a 2-liter bottle of Coke, but it's 1/5 as much Coke, right? It's 1/10 as much Nvidia.
and that is like a pervasive misunderstanding about stock splits. It is.
Yeah.
It,
Yeah.
There's been enough stock splits that have happened in my short time as an individual stock investor to know that the amount of times you have to say it over and over again. I have a good friend who I always thought he was a very knowledgeable investor, and we were chatting about something a while ago, and he was talking about how much of some particular stock that he owned, and he made a comment to me that made it clear that he had no idea how stock splits worked.
Right.
Because he said something about something along the lines of, yeah, it's done really well for me and it's split like 4 times. So now I have like 4 times as many shares, and didn't follow it up with any understanding of, yes, but now it's worth 4 times less in terms of like your ownership
Right.
and all that.
I think
Uh,
I'm going to stop using the pizza analogy and I'm going to start using the bucket of chicken analogy.
The
So,
bucket of chicken analogy.
yeah. So last week, one Nvidia share was a bucket of chicken.
Okay.
Now it's a leg.
I think the
Chicken
pizza's
leg.
better.
But it's overused.
It is overused.
Let it be my thing, Jeff.
Okay, fine. I was listening to a podcast, and David Gardner, has the Rule Breaker Investing podcast, talked about the Nvidia stock split and made actually what I thought was a decent comment. It wasn't necessarily about Nvidia because the price is not exactly what he was trying to say. He caveated the whole stock splits are meaningless line to say, basically, yes, but a company that is not bullish on their future won't do a stock split typically, because now the dollar amount is going to be lower. And if they think things aren't going to go well, they don't want that to go down to $5 or $2 or $1.
Right. Right.
A little different with Nvidia because after the split, it was still over 100. So it'd have to fall a while to get down to like single digits. But I thought that was an interesting, and this is where I think bringing it back to like how investors should think about Nvidia generally and the stock split is, none of the things you hear are ever entirely true. Not mostly a stock split is a non-event, but there are some aspects of it that can tell you that the company is expecting future success or they wouldn't do the split. And
Yeah.
there's all these other reasons why they do it. Like it's easier to give out stock options. It's easier to be, again, this isn't a thing with Nvidia, but I've also heard once that like it makes it easier to get into the S&P 500 if your stock is a certain price.
Because of
Like,
liquidity, right? If your
right.
stock price
So
gets too high, it's not liquid enough.
yeah, but
Yeah.
it's not a trading
Well, and
event. I
options
think
too.
it's
That's an important
options.
part of the
Yeah.
way the market works too, because options stocks trade in 100 share blocks. And
Right.
when your stock price has a comma in it, the options market tends to get really, really small, and that can affect liquidity,
Yeah.
right? So all of those things are tied together. So there are good reasons for companies to do them. They're just not material to generating value for shareholders over the long term. That still gets back to earnings growth, earnings per share growth.
Here's a way I used to think about stock splits when I was a newer investor. So I understood, or at some point I understood, I guess I had to learn this, but I understood that it's a non-event in terms of it's your value as a stockholder, right? You still own the same amount of the company. But I used to think when I was like newer and I was a little bit more short term in terms of like trying to ride the wave of the pops that happen.
Yeah.
So I knew two things. I knew that how the stock split worked, but I also knew that typically after a stock split, the stock goes up a little bit, right? Probably because of all the people who don't understand what's going on
Oh,
buying
yeah.
into the
Yeah, yeah,
stock right
yeah.
after the split.
Right.
So I do remember thinking, oh, I'll wait till the day of the split or the day before and I'll buy some because the next day people will be excited and it will go up and I'll make like a 6% profit, or whatever the
You'll
number
do a
was in my
quick
head.
trade. Yeah, make a little bit of money.
And as I learned more and became a little bit more long-term focused and didn't want to be stressed out by trading, I stopped thinking that way. But I do think there's probably a decent amount of people who have that exact thought of like, oh, if I'll buy a little the day before, if it goes up 5%, 6%, 2%, whatever, I'll sell it and I'll make a little profit. And I guess if that's the game you want to play, what we talk about here is owning great companies for a really long time. And in that sense, it's not material.
Yeah, no, that's exactly right. That's exactly right.
Hey, everybody, we'll be right back. But first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on more than 1,500 stocks. Want to see Netflix's average revenue per member over the past 10 years? FinChat's got it. Do you like to track YouTube's advertising? They've got that too. Want to see how much of Celsius's revenue comes from Costco? You guessed it, they've got it. The breadth of FinChat's segment and KPI data is truly one of a kind. I use FinChat all the time and I love it, especially for checking out the KPIs of all the stocks in my portfolio. To get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Do you like learning about investing, researching stocks, learning from great investors?
If you listen to Investing Unscripted, then the answer is probably yes. So you need to be listening to our podcast called Chit Chat Stocks.
On Chit Chat Stocks, we do hour-long stock research episodes on your favorite companies, analyze legendary investors, and interview experts in the world of investing.
Get started listening today and come learn along with us. Follow Chit Chat Stocks on YouTube, Spotify, or Apple Podcasts.
Going back to the thing I wanted to dive into. So I was reading the Poor Charlie's Almanac while I was on vacation, which if anyone doesn't know, it's a compilation of talks that Charlie Munger has given or had given over the course of his life to a group of lawyers or to like the class reunion for his Harvard Law School or whatever.
Yeah.
And I got about halfway through it so far. It's on like 5 or 6 of the 11 chats or 11 talks in. And they're repetitive in the sense that he comes back to some of the same phrases that we've all heard. You know, if you don't do this, you're just a one-legged man in an ass-kicking contest. Like that's a common Mungerism that comes throughout the book. But he's very clear about certain things. Like, for example, the idea of just not being super active and just waiting for a really big fat pitch, like an obvious company that's trading for less than it's worth, and then making a big bet. And the thing I wanted to talk about was how different that is from how I think most people do. And to put my thumb on the scale on the conversation, how most people should invest. But it is an interesting thought experiment about being too active. And so I think that's in it. So that it was like I was reading all that Munger stuff and it's got me thinking like, okay, I should trade less. I should buy less things. I should have a smaller portfolio. Then there's all this Nvidia stuff. And then at the same time, I spent a lot of time reading some of the 10Ks and earnings transcripts from the companies I own because I had the free time to do it. I was on vacation. And that got me excited about some of the stocks in my portfolio. And I want to add a little more and add a little more. And I'm basically thinking about dollar cost averaging into those companies, right?
Right.
So I think that's a fun place I want to go next is when you read something new or come across a new thing and it gets you thinking one way, how to not let yourself be swayed too much into how one person thinks about the world because it's just one person. And as I think we're going to talk about, Charlie Munger had some advantages in life that the most retail investors do not have.
Yeah, I think one of the interesting things about that too, Jeff, and you and I talked about this offline when we were kind of roughing out the idea for the show, is it's also where you can study the best investors, some of the most successful people out there, and how goddamn hard it can be to apply the things that they talked about in the real world for yourself. And how sometimes you just kind of have to pick and choose, if not outright ignore what they say, like the Munger thing. I think the spirit of it is great, but this guy was loaded before he really started giving all this great investing advice. And that meant that he could sit around and wait.
And read.
Um,
That's the
yeah.
other thing about, that's another theme that comes throughout his talks is basically he talks a lot about interdisciplinary thinking, right? So if you're an economist, you should understand philosophy, history, and math and science, and then apply all those things to business, right? And he's very well read. I mean, he's quoting Greek philosophers and Enlightenment thinkers. And that, yeah, if I had enough money to just spend all day, and this is a Warren Buffett thing too, right? They both spend an incredible amount of time just reading. And Charlie Munger's life advice is like, get smarter every day, which is great. I'm not crapping on that idea at all.
Yeah. Yeah.
But I don't have, again, this is where like it kind of came to me while I was on vacation because I was like, this is great. A whole week to just sit down and read and relax. But that's 1 week out of the year, right? I can't do that. The
Right.
rest
That's
of
just
the time.
another day in the office for Warren Buffett.
Right.
Yeah.
Yeah.
Yeah, exactly.
So that's what I guess this is what I'm getting at. I think we all have to be careful when we emulate any of the big famous investors, right? Not just Warren Buffett or Charlie Munger, but any of them. And remember that all of them have advantages in whatever way that a lot of us don't have, whether it's intelligence or time or
Right.
financial resources or access to people who are also very knowledgeable. And I could see a new investor like I was when I was reading as much as I could and all the classic books, One Up on Wall Street and Common Stocks and Uncommon, whatever it is, and being like, oh, I like that, I'll do that. Oh, I like that, I'll do that. And you can very easily kind of be swayed. But then the reality is you can't replicate that in most cases. And you also have to be true to who you are as a person. I don't know if I have the risk tolerance to be like Charlie Munger. He talks about the fact that he's got like a very high risk tolerance and has no problem losing a lot of money if he thinks he's right, you know?
Yeah, this is something that I've thought more about probably over the past 2 or 3 years than I did all of the rest of my investing career before that. I spent a lot of time looking for an edge, trying to emulate other investors, trying to figure out what they did that worked. And the more I've thought about it, for some reason we treat investing differently than we do art, photography, science, athletics. You could learn LeBron James or Michael Jordan's process, everything they did, and follow it to a T. And you're probably still not going to be better than a backup college scholarship basketball player, right? There's a certain amount of physical gift that you have to have there. You can study all the physics you want and still not have Albert Einstein's brain. But you could go to Yosemite with all the photography equipment in the world and follow the weather patterns perfectly and still not replicate Ansel Adams' photos of Yosemite. But we make the mistake of trying to do that, I think, with investing sometimes a little bit too much, where we try to copy or clone somebody else with our own process. And kind of building on what you were saying, I think there's still a tremendous amount of value in reading and studying people that have been successful. And kind of my distillation of of Munger's process and like what you're taking of that process and what you do with it is very individual, like you're talking about. But I think it's really like there's three things because we're so action oriented. There's always three things that you can do. Munger's one of his famous things that he said a ton of times to paraphrase is you should spend the vast majority of your time sitting on your ass or sitting on your hands. And so that feels like you're doing nothing, right? But really what you're doing is you're trusting the people that run the company that you invested in, right? And you're trusting the value of whatever that enterprise has, whatever competitive advantages it has, market opportunity, like all that stuff, right? You doing nothing is you've done your part. You've committed your capital, right? It's up to other people to do the work. But what do you do during that time? And this is where I think Munger is vastly important to individual investors to learn about, is that while Buffett will sit there for 10 hours a day reading filings, Munger was reading everything. So a good thing to do when you're supposed to be sitting on your hands is building your knowledge of the world. I think that's incredibly, incredibly valuable.
Yeah, and this feels vaguely related to what I wrote about in the newsletter a couple weeks ago at this point when people are hearing this, which was about borrowing conviction and
Yeah.
the idea that I'm starting to think that it gets a bad reputation and maybe it shouldn't. But if you think about it, and this isn't just within investing, anything you learn over a career or many, many years is always in a combination of all the things you've learned from other people. Like I think about teaching, for example, right? Because that's my day job. The best teachers probably do have some innate talent, right? I'm not going to say that everyone is born at the same level of being a good teacher, but I think the best teachers, when they get to the end of their careers, are, I'm going to say 70% just because they've seen so many things and they have so many tricks and tools in their toolbox and things to pull out in any particular situation that only comes with experience. But a lot of those things were probably not things that they came up with out of nowhere.
Right.
It's, oh, I saw Jason do this really cool thing. So now next
Yeah.
time that opportunity comes up, I'm going to do that. I saw this thing that Jeff did. I thought it was really neat. So I'm going to do that. I mean, that was my teaching career. Like it was a amalgamation of all the different things I'd seen over the years. And I think in investing, it's the same thing. If you do what Charlie Munger did and
Steal great ideas from really smart people.
yeah. So that's to your point about we can't emulate or replicate what the great investors do. I think we absolutely can read a 500-page book about Munger and pull away 2, 3, 4, 5, whatever ideas to just let live in our brains and inform future decisions. So I'll give like a good example. The whole idea that he talks about waiting for that fat pitch and then making a big bet. That may not be for everyone, but it might make someone think to themselves, I should keep a little more cash on the side than I normally do so that when I do have a really high conviction idea, I can put a little bit more towards it than I would normally. And I remember having that desire through a lot of 2022 as I was worried about everything because everything was going down.
Yeah.
There were some opportunities where I was like, oh man, this would be a really great time to have an extra 10 grand because this stock looks really undervalued. So
But it's not, I mean, the thing about it is that, and this circles back to something we talk about pretty regularly, and that's having a toolbox and building a framework. It's one thing to just say, oh, I should have extra cash around. If you've never been able to maintain a cash position in your investing portfolio before, what the heck makes you think you're going to be able to do it now, right? What you're going to have to like know thyself, that Greek maxim. I think it's so important.
well, but that's what I mean. Like, yeah, I agree with you, but that's what I'm
Yeah.
trying to say. Like, maybe you need to hear it from multiple people and then you become that person. And maybe you don't.
Right.
But I think if you're a new investor, you don't know who you are as an investor yet. I
Right.
think that takes
Right.
time.
Yeah. No,
Maybe
that's
there's-
true. I mean,
Maybe
think
there's some
about-
people
think
out
about-
there who are like the same person they were the day they bought their first stock as they are the day they buy their last or sell their last. But I think most people evolve in some way over time. And I think that is influenced by all the little things along the way that you pick up from people in your life, books you read, famous investors, and so on.
There's something you said that really stuck with me when thinking through this whole thing and kind of is one of the outshoots of reading Poor Charlie's Almanac. And this is something that you've known. It wasn't particularly new, but the way you put it, it's just so elegantly simple. Learn instead of trade.
Hmm.
When you
Yeah.
feel like you need to act, the action probably needs to be getting a little bit sharper on the companies you own, the industries your favorite companies are in, yourself, right? Read a book on philosophy, like read a book on human behavior. There's so many powerful things. Go reread The Psychology of Money, right? Things like that that can really, that's where you find your edge.
Yeah.
You don't
And
find your edge on CNBC.
I think it can scratch the itch of feeling like you need to do something,
Absolutely.
you know, and we talk about
Yeah.
putting friction into our processes, like, okay, you have a good idea, don't trade on it for two days, or give yourself a week, or, you know, we've talked about things like that before. One thing that I thought of in particular for me is there's sometimes where, you know, several weeks have gone by, my cash is starting to pile up because I just have like automatic transfers into my brokerage account, and I have whatever it is. I have a little bit of free time on whatever day during trading hours, and I start to look at my portfolio, and then I start to think, oh, you know, I haven't bought anything in a while. Let me see what's going on, and I start looking at everything, and I almost start to talk myself into having to do something. And I would say most times I walk away, like because I can't make a decision. I'm looking at this company, and then I'm like, oh, maybe it's still too expensive, or I look at that company, and I'm like, I'm worried growth is slowing down, and I end up talking myself out of doing anything. But not all the time. Sometimes I just go like, I want to buy this, and I do. And I think what I should probably do is go read something like, oh, I'm interested in, maybe I think Nvidia is not that expensive, and I'm considering adding to my position. Well, maybe I should go read about Nvidia a little bit more. Go back and reread the earnings transcript, or go back and look at the 10Q again and look at my spreadsheet. Are things heading in the right direction? You know, so maybe that's the thing I need to force myself to do, to scratch that itch of I have to do something, you know?
Yeah.
And in particular
Well, and
with
sometimes
Nvidia,
it can be a good opportunity to go read, say, AMD's annual report.
yeah. What are they saying about demand
Right.
for AI chips? Yeah.
And of course, you're going to hear companies that sell chips and that are looking to sell more chips into that market. They're generally going to say bullish and positive things. But go find their annual report and read the section on risks, right? Reread that and start thinking about it. And then go out there and go to the Gartners of the world, or some of the big funds that do a lot of research on technology companies that are really deep into AI. What are they saying? Like, what are the projections they're putting out there? And let's apply the Munger filter to it again. Invert, right? They're saying it could be, like AMD's CEO on their last call said, by 2027, CapEx for AI hardware could be either $300 or $400 billion in 2027. That's 2.5 years from now, right?
Yeah.
And that's a gigantic pile of money. That's a lot bigger than the amount of money that's being spent on AI hardware and software, like the CapEx that's being spent right now. But what happens? What are the assumptions that they're making to get to that number, right? And what has to happen to get to that number? So you start thinking through that, and then again, applying the inversion principle to it, and start poking holes in it and saying, well, okay, but what if it's not, let's say it's $300 billion in CapEx. Again, just use a big number. It's a lot bigger than the number now. Let's say the number is half that. What would have to happen for it to be half that? What would be the cause of that? And then you might get to the point to say, you know, there's certainly risk, but the upside looks good. And I'm thinking 10 years from now, whatever happens with AI over the next 2 to 3 years, 10 years from now, it's certainly going to be a much bigger market. I'm willing to risk on and add 0.5% to my Nvidia position or whatever, because it's still not whatever. You start doing like the internal measurements of risk and opportunity versus being oh man, it's going to be so much bigger. I'm at 10%. Let's go to 15. And you're going to retire in 10 years. And well, guess what? That's 3 months of your income that you just pissed away because you weren't fully thinking through the repercussions. So
Yeah. And it all of everything you just said goes back to, I think, the fundamental difference between what we think of as investing versus what trading is.
yeah.
And
Yeah.
unfortunately, there's a lot of people who don't think through it like that at all. It's completely price based. This has gone up, this has gone down. And some of those people luck out, right? Like they buy a stock because they're interested in it, or it's hot and it goes up 200% in a year, and then they decide to sell and they're just lucky. They time the bottom, they time the top. And I think so,
this is, go ahead.
no, it's just I wanted to kind of pivot to like the other half of what I was thinking as I was reading through the Munger book, which was I would read a couple chapters of that and I'd be thinking I need to own less stocks and make less decisions. And then I would flip through a 10Q or an earnings transcript for a company I own and find myself feeling bullish, right? Like, oh, things are heading in the right direction. I like what management's saying. I want to buy some more of this. And then it reminded me that my process has always been some form of dollar cost averaging. Always.
Yeah.
It went from every week to now like whenever I feel like it. But my process is still, like you said, know thyself. My process is still going to be to take smallish, over time, slightly larger bets on the companies I have high conviction in until I build those positions out to be whatever I decide is an appropriate quote unquote full position. And then, like you said, now it's the company's turn to do all the work for me.
Yeah.
But I'm still in that stage of building out those positions. And I think for me, that's appropriate because I don't have all day to read. I'm not Charlie Munger. And I just can't live in a world where I save 6 months worth of salary and then decide one day, this looks cheap. Let me put all my money on that. And if you have a long-term mindset and pick good companies, you can buy them dozens of times over the course of decades and still have a 10-bagger. Like, it's possible.
Yeah,
So,
I think so. A couple things. I always love to push back when we talk about great successful investors and the things that they say, because I think one of the things that Munger did when he spoke publicly was use a little bit of hyperbole to emphasize points, be a little bit rhetorical. And again, this is more Buffett than Munger. Buffett was really the core capital allocator, even for the majority of the time they worked together. He would consult with Munger, and Munger would bring him ideas. And when Munger was younger, he was pretty deep in the trenches of finding opportunities and that sort of thing too. But it's one thing to say, find those fat pitches. It's another thing to consistently do it. We can look at the Berkshire portfolio over the past 10 or 15 years, buying ConocoPhillips and ExxonMobil, both when oil was $120 a barrel back in 2014, 2015. And then so basically buying the top, right, of a cyclical industry. At that point, I mean, I know Buffett was a younger man and Charlie was a younger man. He was only, 80? So the point is this is somebody that was deeply experienced that still made that mistake, right? So you're not going to get it perfect, but it always kind of takes me back to, I think maybe the more nuanced way to think about it, and this is probably something that I think Munger would wholeheartedly agree with, that the goal was really more just about reducing your errors, particularly unforced errors.
Yeah.
Morgan Housel wrote an article when he was writing for The Motley Fool, back when he and I were colleagues, and this was one of my favorite articles that he ever wrote. And he talked about the difference between extremely talented amateur tennis players and professional tennis players. And by and large, you could take these two cohorts, that the overlap in physical abilities was exceptionally parallel, right? There are some incredibly physically gifted amateur tennis players out there. The reason they're not professionals is the number of unforced errors they make. And an unforced error is defined as, it's not you took a bad shot because your opponent put it in a place where it was going to be a bad shot. You just made a bad shot, right? It was an error that you were not forced into. And the number of unforced errors for professional tennis players is like an order of magnitude lower, like it's substantially lower. And I think generally for investing professionals, it's exactly the same thing. And so the three things that I think coming out of like the Munger process to me are, we've talked about when you think you should be doing nothing, the something that your brain is telling you to do is learning instead of trading, like you were talking about. But I think a big part, and this is the number two, is making that really good decision every few years. But the way you get to make that really good decision every few years is by doing the third thing, which is minimizing the number of bad decisions that you make.
And that's the other thing I struggle with the whole make less decisions. And like the flip side of that, I guess what I'm trying to say is sometimes it's the bad decisions that you learn from, right? So the other piece of it too is like if you only buy something every 6 months, maybe you're not making enough mistakes to learn.
Right. Yeah. No,
again,
that's
like
fair.
I'm
That's fair.
thinking about
Because
this
it's-
mostly for like a newish investor. Like obviously if you're
Yeah.
80 years old and you've been investing for 50 years, different ballgame maybe. But so much of what I've learned to whatever extent I've actually learned it is because I've probably made 10,000 purchases of stocks at this point, because some of them were like really tiny couple dollar ones I made like every 3 days back in 2020.
Right.
But each one of those is like a data point about whether I was right or wrong.
Mm-hmm.
And as I've gotten more experienced, I've felt comfortable making less of those. But a lot of those like dumb decisions were informative. So that's why, again, like I keep coming back to, for most people, I think some version of dollar cost averaging is probably the smart way to go. Not blind, unthoughtful dollar cost averaging, but making the best informed decision you can at the time with a reasonable, smart amount of your capital, and then evaluating.
Circling back to David Gardner, one of my favorite things about David is his just general optimism about investing, and that kind of that core tenet of averaging up beats averaging down, and the odds are in your favor when you are a regular buyer of stocks and you hold for a long period of time, because the market does go up more often than it goes down, right? And when we wait for those opportunities for sell-offs, if that's your process of just waiting for sell-offs, if you bought in 2009 at the bottom there, you did really, really well. But if you didn't, and you were waiting for the next sell-off, the market was up a ton, right? It was up more than double before you saw another 30% drawdown, right? So sitting on the sidelines, you're watching all of the buses go by, waiting for the perfect bus. You know, you miss a lot of buses that way, and you don't create wealth.
All right. So to end with a Munger quote, I have nothing to add. So why don't we take a break? And when we come back, we'll do a quick review of the May results from our portfolio contest. Hey, everybody. We'll be right back. But first, a word from our sponsors. Earlier in the show, you heard us talk about investing platform public.com. That's where you can trade options with no commissions or per contract fees. And you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carries significant risk. Full disclosures in podcast description. U.S. members only.
Hey, Jeff, time for that portfolio contest update, but it's starting to get a little repetitive.
It really is. So if anyone's new to the podcast, we have a year-long portfolio contest with a bunch of picks by people we had on the podcast as guests last year, but also by some audience members who wanted to submit some ideas. We talk about them briefly every month, and then we talk about them in detail every quarter. We declare quarterly winners, and then we give money to charity. And you can get the link to this Google Sheet with all the results in our show notes. So we're going to spend just a few minutes to wrap up today's episode talking about the results for just the month of May. So this is not year to date. We're going to talk about
Not cumulative, just
not
May 1
cumulative,
through
yeah.
May 31.
just the month of May. And to recap, the winner...
I don't know why I felt it was necessary to describe in more detail what you were describing perfectly well.
It's one of your fatal flaws.
Fair enough. I have nothing to add.
Stand-up comedian Mitch Fatel has been dominating the monthly competitions. He won January, March, and April. And technically, he won May. And here's what I mean by technically. We did have 2-stock portfolio because we had 2 people who sent us just one idea. And the rules of the game were you have to have 3 to 10 stocks. So I put them together as their own little 2-stock portfolio just to not exclude them from our fun. And due to a very big jump in one of those 2 stocks, that 2-stock portfolio was actually up 38% in the month of May. So technically, that would have been the winner. But I think, Jason, and you can tell me if you agree, that we should not count that as the official winner because it was only 2 stocks. And that was not the original rules. But in order to go down that path, it would mean that once again, stand-up comedian Mitch Fatel has won a month of our portfolio contest with his stocks up an average of 18%. So other than the dominance of Mitch, what else jumped out to you in the month of May?
So once again, my portfolio is by far the worst performing portfolio of the entire contest so far.
But not in May.
No, that's true. That's true. In May,
You
it
had
was
a good
actually
May.
positive. It was
If
actually
you're going to
up
have a
14.
comeback, it started in May.
I could because I'm a very good stock picker. No, it was up 14% in May, largely because TPI composites did really well and Outset did far less horrible than it has been doing. So
Yeah.
that was good. But it just the randomness of the market continues to be so fascinating to me after all these years. That's the thing that kind of stands out to me the most. What about you?
I was just going to say the same thing. I'm less surprised by it because this is the second year we've done the contest. My big takeaway in the first half of last year was how ridiculously volatile some stocks can be month to month. You can have a month where a stock is down 35%, and then you can have a month where that same stock is up 72%. And that can happen just in the first 5 months of the year. And that's wild to me. And like you said, it never continues to not be interesting. So I think, again, for anyone who's new, maybe recently found the pod, go ahead and click on that link and check out the spreadsheet because you will see how, as you follow any particular stock from January through May, how the month-to-month gyrations of the market can be very, very severe. And we say up front that this is just a fun one-year stock picking game to A, give money to charity, and B, have interesting insights and things to talk about and drive some engagement with our guests and our audience members. But I think it's a better teaching tool than maybe we even anticipated when we started this two years ago, just because of what we just said, just how crazy it can be month to month.
All right, so there's 3 other points that I want to make, Jeff. And this, we're going to need to go back to the 2023 investing portfolio contest. So the link will be in the show notes. There's 3 tabs. So first one, the magnificent 7. So back in August, Jeff and I proposed each an alternative stock to each of the Mag 7 stocks that we thought might lead to better returns possibly, but were certainly alternative investments.
Had to be related to the Mag 7 stock in some way.
In some way, yeah, in some way. Mine has consistently outperformed it. It's up like 49%, the Mag 7. Yours is up like 17%, so yours has consistently done better than mine. But Nick's picks up 53.7%.
Yeah, I have to, and this is going to be a nice way to end the podcast because it's going to tie right back to Nvidia. Back in October or September, I guess it was, I won $500 in a raffle, and my dad said something along the lines of, you should buy a stock you'd never buy with that money just for fun. And I said, well, that's a lot of money to do something like that with. I said, but here's a game we could play. And I challenged him to pick 5 stocks that he thought were good investments based on listening to the podcast. And I said, I will put $100 in each one and we will track it on the show. And he is crushing it, as you said, up 54%. But it's because in October, one of his picks was Nvidia. And I remember thinking at the time, and I probably even said it, wow, I'm not so sure I'd pick Nvidia right now. It's been quite a run. And here we are, 169% later. And I think there is no better way to wrap this up because I would have absolutely agreed with you if you said to me in October of 2023, I can't buy Nvidia right now. It's too stupidly expensive. It's gone up. There's too much froth in the price. And who knows, this could all turn out to be correct if a year or 2 or 3 from now, the stock's down 90% for some reason. But as of right now, about a half a year later, yeah, he's looking like a good stock picker here.
I have a better way to end it. I think this is important. We're about a year and a half in, so we have a little more evidence. It's closer to long term. My 2023 portfolio is up about 125%. So I might still be the best stock picker of them all.
All right. I'm going
Probably
to
not.
end it. Here's how I'm going to end the show, because we can't end it with you being that ridiculously arrogant. The unportfolio, which was 4 stocks that we picked that we didn't think would do well, and I blew that because I picked 2 stocks that just really did great that year. But I'm turning into someone who's maybe a little bit more right on one of them, as Tesla has given back a lot of its gains, and now that portfolio is only up 51%.
The portfolio that was
all of this
supposed
is
to be
stupid. I mean, let's be honest,
Yeah.
even after a year and a half,
it's fun,
not,
but it's fun.
it is, it's fun. And I think it's given us a lot of good stuff to talk about and find a lot of learnings in these fun little portfolio contests. So yeah. All right. We can end it there. Check out those portfolios if you want to. The links are in the show notes. And I'm curious, as we do our housekeeping here at the end, I'd love some feedback on what we talked about today. If anyone has any thoughts about the craziness in the market, different ideas about investing, knowing yourself and knowing the kind of investor you are. And if you enjoyed this conversation and would be so inclined, we always appreciate reviews and ratings on the podcast apps. We are a free podcast that doesn't have any famous people on it. So those stars and ratings really help people find the show and helps us grow our subscriber base. And if you want a transcript of the episodes and our random thoughts every Sunday, you can sign up for our newsletter at investingunscripted.com.
I think that's about it. Jeff, I think we did it.
We did it.
Thank you, Apple Podcast people. You're doing better about the reviews. Good job.
Yeah.
Good job. Okay. As always, we love to share our experiences, talk about our mistakes, the things that we're trying to do to answer the hard questions about investing for ourselves. But it is up to you, dear friends, to find your own answers. Charlie Munger's answers are not your answers. Jeff's answers, my answers, are not your answers. You can borrow them for a while, but eventually you have to make them your own. You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.